And so we have question number 7. Let's start with question number 7. And so the question reads, what is monetary policy? What is monetary policy? Anyone to try this one? You can say it in your own words. Hello, what is the monetary policy? What is the monetary policy? So it is the policy that guides money supply, okay? It is a policy that guides the central bank on money supply, the supply of money. So just as I did indicate last time, when we have got too little money in circulation, then the central bank has to increase the supply of money. And again, when you have got too much money in supply, then the central bank has to reduce the supply of money. Now, there is some policy that helps or that guides the supply of money. That policy is called the monetary policy. Any question?
No question.
Okay. The question reads, illustrate how the central bank uses the monetary policy tools, the open market operations, OMO, the reserve requirement, and the discount rate to influence money supply. Understand this question it has got a lot of things, okay? So you are asked to illustrate how the central bank uses the monetary policy tools. The first one is open market operations, OMO. The other one is the reserve requirement and the discount rate. 3 of them. These are the main tools that the central bank uses to control the supply of money, okay? They are the main tools. But what does the central bank do? Let's start with the open market operations, OMO. So open market operations, OMO, is about buying or selling of government securities, as said last time. So what happens, let's start with when you have too much money in circulation. When you have too much money, what does the central bank do? How does it use the open market operations? So when we have too much money, the idea is that they have to reduce the supply of money. So how do they reduce the supply of money? Via open market operations. They sell, right? They sell the bonds and what? And the securities. They sell the securities. They sell the securities such as the treasury bills and the government bonds. So when the government starts selling the bonds, they start selling the treasury bills. The idea is that you should get your money and take your money to the central bank. Then you remain with the securities. You buy the securities. So you'll be using the money to buy securities. So that money that you're taking to the central bank, then the central bank shall keep the money. So that is one of the ways on how the central bank uses the open market operations to control money supply, especially when you have too much money supplied. Is that clear?
Yes, it is, sir.
Okay. Then when we have too much money, how does the central bank uses the reserve requirement? I think you can now relate with this one, the reserve requirement. How is it used? Okay. So to start with, the reserve requirement, actually, the reserve requirement, it is the amount, just as I said, the amount of money that should remain at the commercial bank, okay? There should be some amount of money that should remain at the commercial bank every time you make some deposit. For example, if we say it is 20%, the reserve requirement ratio is 20%. It means that 20% of every unit of money deposited should remain at the bank to meet the demands of those withdrawing. Okay. So, for example, if you deposit 100 kwacha, then the 20% of 100 kwacha is 20 kwacha, which simply means only 20 kwacha should do what? Should remain at the commercial bank. Then the remaining 80 kwacha shall be issued out as the loanable funds, right? The loanable amount. This amount will be sent as a loan, right? That's what usually happens. So now, how does the central bank uses the reserve requirement? So what they do, if they want to reduce the supply of money, when you have too much money, they want to reduce the supply of money, they increase the reserve what? The reserve requirement. Is that clear? Now, when they increase the reserve requirement, what this means, this simply means that when the reserve requirement has been increased, it means that there will be more money that the commercial banks should keep to meet the demands of those people withdrawing. Now, if the commercial bank is forced to keep a lot of money in the reserves, it means that they will not have enough money to do what? To issue as loans, right? For example, we say, I gave you this example, we were saying at first it was, let's say 20%, right? Only 20%. You deposit 100 kwacha. So it means that 20 kwacha only should remain, okay, at the commercial bank. But what if the reserve requirement ratio has been increased to 30%? They say, oh, you have to keep 30%, which means instead of keeping it, let's put it at even 40%. So instead of remaining with the only a 20 kwacha, they'll be remaining with a 40 kwacha, right? They'll be keeping a 40 kwacha. It means that 40 kwacha will remain at the commercial bank. Then the 60 kwacha is the one that will go into what? Into circulation. So when the central bank wants you to reduce the supply of money, actually, what they do is that they increase the reserve requirement. To increase the reserve requirement simply means that increase the amount of money that should remain at the commercial bank. And that, you know, that the implication of that is to reduce amount of loans, isn't it? So you know that the loans are the ones that you issue, go into circulation. When you issue a loan, people get that money and that money will go into circulation. So once we reduce the loans, it means we are reducing the money that goes into circulation. Is that clear? Hello?
Yes, sir, it is.
Okay. So basically, that is what actually happens. What about, let's look at how the the central bank, we are answering question number 8, those that have just joined. The question is, illustrate how the central bank uses the monetary policy tools, the open market operations, the requirement, the reserve requirement, and the discount rate to influence money supply. So it started with the scenario where we have too much supply of money, okay? When we have too much supply of money, we said, number one, the central bank using open market operations, number one, they sell the what? The securities. That is what we've just said. They sell the securities, they sell the bonds. Then using the reserve requirement, they increase the reserve what? Requirement. What about the discount rate? To start with, we said that the discount rate, it is the interest rate that the commercial banks give to the central bank, right, for borrowing. Remember, who are these? The commercial banks, they borrow money from the central bank. Okay, So usually there is an interest rate that is usually charged. Now the rate, the interest rate at which the central bank charges the commercial banks for borrowing, it is called the what? The discount rate. So when the central bank wants to reduce the supply of money, what they do actually, they increase the what? The discount rate. They increase the discount rate. So when you increase the discount rate, the implication is that it will become one, expensive for commercial banks to borrow money from the central bank. That implies commercial banks will not borrow money from the central bank, which means that they will not have enough money to issue out as loans, right? As loans. So if the commercial banks don't have enough money to issue out as the loans, then that will reduce the supply of money. So basically, that's how the central bank uses these tools, okay, to control the supply of money, to be specific, when there is too much money in circulation. Is that clear? Hello? Are people following?
Yes, it's clear.
Do we have anyone with a question?
I just wanted to do a recap on the definition for the discount rate.
So the discount rate is the interest rate that the central bank charges the commercial banks for borrowing. You know, the commercial banks usually they borrow money from the central bank so that they can use that money to give loans. So there is that interest rate that the central bank charges these small banks for borrowing. Okay, that interest rate is called the discount rate. Is that fair?
Yes, sir.
Okay. So now let's take the other scenario. Let's take now that there is, let's say there is too little money. There was too much money. Now we have got too little money. That is the other scenario we have. Let's say we have too little money in supply. So what happens? How does the central bank use these tools? There are three of them, right? You can see they are three. How does the central bank use these tools to start with? So when there is too little money, they use the open market operations by doing what? By buying what? Bonds and securities. So what happens is that the central bank buys bonds and securities from the corporations. They're what you call corporate bonds, okay, from corporations. So the commercial bank buys the bonds, they buy securities from the public. So as they buy, it means that they're giving money, isn't it? So the government, the central bank will use money to buy the bonds and securities. By so doing, they shall increase the supply of money in the economy. Is that clear? That is how they use the open market operations, OMO, when there is too little money supply. Is that clear? It's just the opposite of what we just said. About the reserve requirement, they just, when we have too little money, we have to increase the supply of money. So if they want to increase the supply of money, what happens is that they reduce the what? The reserve requirement, right? When they reduce the reserve requirement, I said this means that there will be more money that will be available to commercial banks to give out as loans, right? That's what happens when the reserve requirement has been reduced. It means that the amount of money that will be available for commercial banks to give out as loans will be increased. And when that increases, more money will go into circulation, especially via loans. Is that clear?
Yes.
About the discount rate, again, when we want to increase the supply of money, we reduce the discount the discount rate. You reduce the discount rate. Now, when you reduce the discount rate, what happens is that it becomes cheaper for you to borrow money. Oh, sorry, for the, which one is this? For the commercial banks, it becomes cheaper for commercial banks to borrow money from the central bank. Now, if they can easily get a loan from the central bank at cheaper cost, it means that the commercial banks will borrow a lot of money from the central bank. And when the commercial banks borrow money, they are going to use that money to do business. They are going to give out loans. So we will have a lot of money supplied in the economy. Is that clear?
Yes, sir.
So this time around, I call for questions on the monetary policy tools, how they are used to influence the supply of money.
Sir, I think I joined a bit late. Could you please explain on the first two, when there's too much money in the economy?
Okay, when there's too much money in the economy. To start with, the open market operations, I start with the open market operations. So what happens is that they sell the bonds. They just do the opposite. When you have too much money, they sell the bonds and securities. When they sell the bonds, what it means is that they are buying. You know, when you have too much money, you have to reduce the supply of money. So to reduce the supply of money, you sell the bonds. Then people will get the money that they have and use it to buy the what? The bonds and securities, okay? By so doing, you're reducing the supply of money from the public. Did you get the OMO?
Yes, sir. Thank you so much.
Okay. About the reserve requirement, I did say that this is the amount of money that is required for a commercial bank. That the commercial bank is required to keep to meet the demands of those people who are withdrawing. So when there is too much money, they increase the reserve requirement. They increase the reserve requirement. When you increase the reserve requirement, it simply means you are increasing the amount of money that should remain, okay, at the central bank, okay? You are increasing the amount of money that should remain, that should remain at the commercial bank to meet the demands of those people that are coming to withdraw. And that is what usually happens, okay? You got it?
Yes, sir. Thank you so much.
Okay. So any other question from anyone? Okay. It is well that people have understood. I emphasize that you have to understand in economics, we don't memorize things. You have to understand. This I have been preaching. Okay. Explain the difference between expansionary and contractionary monetary policies. So what is the difference? Yeah, okay, it's just basically the same thing that I've just explained. The expansionary the expansionary monetary policy is used to increase money supply. This simply means increase money supply, okay? Increase money supply. That's about it. That's expansion. Then when you embark on the contraction, the contractionary monetary policy, it means that you are reducing the supply of money. And the other name for the contractionary monetary policy is restrictive monetary policy. Restrictive. Okay. Restrictive monetary policy. So that's the difference. The expansionary one, this is when you're increasing the supply of money. And you know the tool, how to use those tools. I've already explained how to use the tools when you want to increase the supply of money. And about the restrictive, you have to reduce the supply of money, and you know how to reduce the supply of money. I've just explained that in the previous question. Is that clear?
Yes, sir.
Yes.
Any question?
No question.
Okay. Explain the liquidity preference theory. According to this theory, what are the motives for holding money? So the liquidity preference theory, this is a theory that states that people want always to hold money for various reasons. Okay, people want to hold money for various reasons. So that is the liquidity preference theory. Now, according to this theory, there are different motives why people want to hold the money. And to start with, there is what is known as, let me start with there is a speculative motive. I'll explain what it means. Then these are Keynesian motives of holding money. That's according to the liquidity preference theory. Speculative. The other one is precautionary. And then the other one is for transaction motive. I explain what they mean one by one. Actually, these are the motives. These are the motives that influence people to hold money. So for the following, because of the following motives, people decide to hold the money. So these are the reasons, the motives. To start with, let's start with transaction, the transaction motive. With the transaction motive, the transaction motive states that people want to hold money, like holding amount of money, cash, to meet the day-to-day transactions, to buy, okay, for buying things. Yeah. So this one is to meet the day-to-day transactions. They do that to meet the day-to-day transactions. That's the transaction motive. Yeah, that's the reason as to why people hold money. That's according to Keynes. Any question?
No questions.
Okay, that is the first motive that influences people holding money. The other motive that guides or that influences people hold money is called the precautionary motive. The precautionary motive. So with this one, it is says that people want to hold money to meet the unplanned transactions, or to meet, you know, the emergencies, so that they can be able to fend their emergencies. You know, there are those things that that happen that require you spending money when you have not even prepared for that, right? You haven't prepared for that, but there is need for you to do it, to hold money. So what usually happens is that you keep money because you don't know the future. Like, you'd want to keep some money. You wouldn't want to keep all your money. Imagine you keep all your money into interest-bearing assets, or just keep all your money into assets. Maybe all the money that you have, you just buy houses, you buy what? You just have assets, in short. And those assets are not easy to convert into cash. You know that. So there is sometime maybe when you need cash right now, like you just need cash. That's why you should keep some money liquid, maybe in the bank account. At least you can withdraw anytime. You know, keep something. So people keep money according to Keynes, John Maynard. The man says people keep money so that they can meet their emergencies. They can meet those transactions that are usually unforeseen. Is that clear? That's the precautionary motive of holding money.
It's clear,
Is that
sir.
clear?
It is.
From the precautionary motive, there is the speculative motive, right? The speculative motive. Now, with the speculative motive of holding money, we say people hold money, okay? The way the speculative comes from the way they speculate. As they anticipate, people always anticipate for the better future. They anticipate that at some time, at some point, maybe, you know, the assets will become cheaper. You get it, right? The assets will become cheaper. The prices of maybe the bonds will become cheaper. The prices of the shares will reduce, okay? So you anticipate that the assets will do what? Will become what? Become cheaper. And you will buy then, right? You will buy then. So there is that time when you are just like, no, in the meantime, I can't buy because these things are still expensive. I'm expecting that maybe after some time, the prices will do what? Will reduce, isn't it? Similarly, maybe just from the practical point of view, when you check, you find that some goods are not demanded during the season when they are highly needed. People don't buy much. For example, let's say people would want to hold money during when the court season comes. Now, most of the things that support the court season, like the blankets, the jerseys, all those things, right? They become expensive. Then others will say, in the meantime, if they have an idea of buying something, during that time, they'll say, okay, we'll just hold the money so that when the court season goes, we will buy. And usually when the court season comes, it becomes hot and the prices of these things go down, right? So in a nutshell, we are saying, or to sum it up, under speculative motive, people hold money in anticipation that the future will have cheaper assets. Is that clear?
Yes, sir.
Any question from anyone? Anyone is free to ask the question. Okay, so those are the three motives of holding money. Those that want to do research in around this field in economics in fourth year. So these are the topics that you should be thinking about, right? You have heard the things, the variables that influence the demand of money. So all that, okay, yeah, we'll talk about those things very soon. Yeah. When you think about doing research, it will be more interesting very soon when you start doing research. Oh, when you reach in fourth year, you will be doing your research. I think it will be very interesting. I enjoy doing research more than teaching this, than teaching, but research is always interesting. Okay. That was just that, but we can now move on Now that we know the different motives why people hoard money, according to John Maynard Keynes, explain the factors that influence the demand for money. So the following are the factors that influence the demand for money. Number one, there is interest, right? There is interest and income. Let me start from that side. Interest and income. So according to income, according to John Maynard Keynes, Keynes said there is a positive relationship between money demand hoarding, get it? Money hoarding demand and income. So the more income you have, the more demand you have for hoarding money. Is that clear? When you have more money, you'd be willing to hold more money. Just that is according to Keynes. It's a theory. Is that clear? These are the
Come again,
factors.
sir.
The two factors that affect, the factors that have influence the demand for money is, number one, we have income, right? It's a determinant. So according to Keynes, John Maynard, he says there is a positive relationship between the money hoarding demand and income. That implies that when you have more money, more income, you'd want to hold more more money, okay? People would want to hold more money when they have got money. That's according to him. Is that clear? So there is the relationship between money holding demand, and between money holding demand and the income. Here, money holding demand, money demand, it is positive. Then with interest, it is negative. The money holding demand, it is negative here. What do we mean by interest? There is a negative relationship. What happens is that when the interest rates increase, the demand for holding money reduces, okay? Practically, what this means is that when the interest rates increase, people will want to hold little money. So they get all the money that they have and take the money to the banks because they want to get some interest for that money. Is that clear?
Yes, sir.
Yes. So that is what happens. So once the interest rates increase, then the demand for holding money reduces. And the opposite is true, implying when the interest rates reduce, then the money holding demand increases. Because you'll be like, even if I leave my money in the bank, nothing happens. They don't even, the money is not even earning good interest. So it's better just keep it. So you demand to keep more money, maybe even in other assets, other interest-bearing assets, unlike keeping it in the bank. But once the interest rate go up, you take your money, then the demand for you to hold money reduces. Is that clear?
Yes, sir.
Yes, sir.
You have to understand these theories properly, and you will be fine. Explain how equilibrium interest rates are affected by money demand and supply. I've already said that. I've already said how the interest rates are affected by money demand and supply. Okay, what is the liquidity trap? Okay, what is liquidity trap? Can start from here so that we can even give you a graph in the long run.